After years of disappointment, emerging market stocks are finally having their moment. The MSCI Emerging Markets Index is up around 25% year to date, while the S&P 500 has risen just 16%. That's the strongest EM performance since 2017, and it's left a lot of investors asking what changed. In this video, we'll look at what's driving the rally, which countries are leading the charge, and whether that rally is set to last. Today's video is sponsored by Freetrade, the commission-free investment platform. For most of the past decade, emerging markets have been the laggards of global investing, weighed down by a strong dollar, weak Chinese growth, and endless trade tensions. Then in 2025, everything flipped. Emerging market currencies strengthened, capital flowed in, and valuations that once looked cheap started to look like an opportunity. So let's dig into the most important drivers behind this turnaround. The 10% drop in the US dollar since January has been the single biggest catalyst. A weaker dollar makes emerging market debt easier to service, it boosts local purchasing power, and it also attracts capital into high-yielding emerging market assets. Historically, emerging markets outperform whenever the dollar falls, and 2025 has certainly fit that pattern. After 2 years of tightening, the Fed finally pivoted in September 2024, cutting rates by about a percentage point last year. And that was followed by a long pause, and then we had 2 more cuts recently as the US job market started to weaken. That eased global financial conditions, and it gave emerging market central banks room to cut as well. In fact, many have already done so. For example, here you can see that Mexico, South Africa, India, and China are well into their own rate-cutting cycles. Cheaper credit is fueling investment and consumer demand across the developing world. And even after that rally, emerging markets in aggregate trade on just 14 times forward earnings, with nearly 12% profit growth expected. Compare that to the S&P 500 on 24 times earnings and similar growth, well, then emerging markets seem to simply offer more value for each pound or dollar invested. This graph shows the forward price to earnings difference of the US relative to other countries. Notice all the numbers are positive as the US is priced much higher than other countries. Now that's not true of all of emerging markets, of course. India is only slightly less expensive than the US. The fourth reason is risk appetite, and it's a crucial one. Late in a market cycle, when investors grow confident that a soft landing is in place, they tend to reach for yield and also to chase performance. That's when emerging markets often shine. When volatility falls, global capital shifts from safer regions like the US into higher beta regions such as China, Brazil, South Korea, and Indonesia. Emerging market equities and currencies typically do best when investors believe the worst is behind them, even if fundamentals haven't changed much yet. In other words, 2025's emerging market rally isn't just about better data, it's about renewed optimism and the global hunt for returns. Today's video is brought to you by Freetrade, the commission-free investment platform. Freetrade has a limited time cashback offer on, and right now you can get 2% cashback when you transfer £10,000 or more in pensions to Freetrade. Cashback is capped at £1,000 per customer, and this offer ends on 31st of December 2025. There's also an ISA deal for new ISA customers. Freetrade's ISA is free, and you can get 1% cash back when you transfer £10,000 or more, with the cashback capped at £1,000. And this offer also ends on 31st of December 2025. Now what I like about Freetrade is the simplicity. So here's the app, and you can invest in a few simple clicks using their web platform or their mobile app. Freetrade's big selling point is that they're among the cheapest ways to invest in a SIPP or in an ISA in the UK, with simple and transparent pricing and a free ISA. Freetrade won Best Online Trading Platform at the British Bank Awards 6 years in a row, and over 700,000 customers trust them. To get started, head over to freetrade.io/PensionCraft or check the link in the description below. October's US-China trade truce took a lot of heat out of the headlines. China lifted export controls on rare earths and the US eased some tariffs, and that was a clear relief for Asian and Latin American exporters. At the same time, the AI boom has broadened from hard tech, so that was things like chips and hardware, to soft tech, so that would be software, internet platforms, and IT services. And that certainly helped some Chinese and Korean tech firms rebound sharply. TSMC and Samsung, for example, which are at the center of the global AI infrastructure boom, have both reported double-digit profit growth this year. Now let's see which countries have been leading this incredible rally. The Korean Kospi Index is up over 50% year to date, and that's been helped by corporate governance reforms, but also the AI semiconductor boom. Given the huge concentration of the Korean market in just 2 semiconductor companies, it's not surprising that the Korean market has surged. Demand for high bandwidth memory chips for the global AI infrastructure build-out is expected to far outstrip its supply for some time. The rally was initially driven by local investors, but now foreign investors are piling in. From May to September of this year, they poured $11 billion into Korean stocks. Taiwan is driven primarily by TSMC. Its chips also power the AI revolution, and profits there are up almost 40%. And after a weak 2024, Brazil's back. The real has strengthened, rates are falling, and valuations remain cheap, under 9 times forward earnings as I make this video. Brazil's stock market surged over 40% in dollar terms thanks to a mix of strong domestic fundamentals, but also global tailwinds. Fiscal reforms, easing inflation, and a rebound in consumer demand restored investor confidence, while a weaker dollar and expectations of rate cuts boosted capital inflows. Domestically focused sectors like finance, retail, and construction led the rally, supported by low valuations, but also improving growth prospects. Mexico's enjoying its nearshoring moment, companies moving supply chains closer to the US. The equity market return is double that of the US, and the peso is one of the world's strongest currencies so far this year. Massive foreign investment tied to nearshoring boosted industrial real estate, but also manufacturing, while defensive sectors like staples and telecoms also supported returns. And again, rate cuts, a weaker dollar, and cheap valuations added to investor appeal. So will it last? The case for continued EM strength looks solid, with some caveats, which we'll come to in a moment, but let's start with the positives. The dollar may continue weakening as the Fed keeps cutting. Emerging markets trade 30 to 40% cheaper than developed markets, and earnings forecasts are being revised up, not down. Plus, there are long-term megatrends. For example, favorable demographics, supply chain shifts despite the US trade war, clean energy and tech adoption. Many of these trends favor emerging market economies. But of course, this is emerging markets, so there are real risks. China's property market remains fragile, geopolitics could flare again, and some markets, like India and Taiwan, now look expensive. After a stellar year, we may see more dispersion. So for example, strong domestic stories like Brazil and Mexico could keep running, while others that depend on the AI infrastructure boom cool off if that narrative does falter. For example, if we break down contribution to 2025's rally for the Taiwanese stock market, the effect of TSMC is huge. And we see a similar pattern in South Korea, where Samsung and SK Hynix dominate positive contributions. And in Hong Kong, the rally generators were dominated by companies expected to benefit from the AI boom, including e-commerce group Alibaba, smartphone maker Xiaomi, and video sharing app Kuaishou. And it pays to remember that EM can always surprise on the downside, with crises materializing very rapidly. Remember that EM is generally higher risk than developed markets, so don't expect a smooth ride and don't invest too much in emerging markets. Keep your tilts reasonable and, of course, be prepared for disappointment. A market cap weighted global equity fund will have around 10% allocated to emerging markets, so use that as a guideline. So emerging markets are back, but this time I'd warn against simply chasing performance. It's always worth trying to work out where the growth is real, where valuations are reasonable, but also where currencies still have room to strengthen. So tell me what you think in the comments. Are you piling into emerging markets, or do you think this is just a flash in the pan, and will emerging markets disappoint yet again? Now don't forget the offer from Freetrade. You can get 2% cash back when you transfer 10,000 or more in pensions to Freetrade. That's capped at £1,000 per customer, and the offer ends at the end of 2025. And of course, there's an ISA deal for new ISA customers where you get 1% cash back when you transfer £10,000 or more, and this time the cap is £1,000. And that offer also ends on 31st of December 2025. And you'll find more details about those offers in the description below. And, as always, thank you for listening.